Welcome to the MoneyShow.com video network. I'm Charles Gifler, and we're here to talk with Brian O'Neill with Morningstar. Morningstar is an organization which has championed the subject of governance, fund stewardship. Give us a little explanation of what we're doing here in Canada on that subject.
What we're trying to do is show people that there's so much more to fund analysis than just looking at past performance of a mutual fund, or maybe identifying who the manager is and what kind of track record they have. That there are a lot of qualitative elements as well. And so the stewardship analysis that we do is really targeted at the fund company level in a quantitative and qualitative kind of fashion. But what we're trying to assess with this analysis is which fund companies do a good job or a poor job of aligning their interests properly with those of unit holders. So do they have the fund unit holders' best interests at heart with the product launches that they are coming up with? Or are they just trying to sell the hottest thing at the time? I'm thinking of internet funds at the peak of the tech boom, for instance, or real estate funds at the peak of the real estate market in 2008. The fund companies that put unit holders first aren't necessarily just trying to sell the thing that's hot. They're offering good long-term solutions with reasonable fees that unit holders can partner with their firm, the types of products where they can be partners for a long, long period of time.
So how does your rating system work? It sounds as if you've really started to compartmentalize it and analyze it in a way that can be predictive.
We have. So we've broken it down to regulatory history, manager incentives, corporate culture, and fees. And so the regulatory history is fairly simple. If your firm is regularly bumping up against the law, you would lose marks there. We do take our cue from the regulators, though. We're not trying to set a new regulatory standard or anything like that. Fees, low-fee firms, we have done tons of research at Morningstar, especially in the US, where low-fee fund companies tend to outperform. It tends to be the best predictor of future performance. Another really strong predictor of future performance is manager co-investment. So that's the manager incentive side of things. So
they're eating their own cooking.
If you eat your own cooking, the analogy I use, I mean, it's not an original one, but if you're at a restaurant, you can take comfort in knowing that the cook owns the restaurant. That's great. But you take even more comfort in knowing that the cook's eating the food he or she just served you. And so it's the same concept with mutual funds. And then finally, the corporate culture analysis actually carries the most weight in our grading. And that comes down to types of products that they're offering. Are they good, like I was talking before, are you talking about gimmicky products, or are they good long-term investments for unit holders? Do they clearly communicate their risks in all of the articles that they put on their website, or required regulatory disclosures? Are they going above and beyond what is required? Do they have a healthy attitude toward risk? Do they have fund managers who are primarily investors and not just salespeople going out shilling product? Are they staying there for the long term, applying an investment process that makes sense? It's a strategy that's repeatable for the long term. So there's so much more to analyzing a mutual fund, we think, than just looking at the past numbers, because you're really trying to assess what is repeatable, what can we expect to see going forward from a risk standpoint, and also from the standpoint of what the attitude the fund company has toward the unit holder and everything that they do.
Well, thank you. We've been talking to Brian O'Neill on the MoneyShow.com video network.